Good afternoon, everyone, and welcome to the Mid-Year CRE Market Update hosted by RealNex. Today, we're joined once again by Dr. Jeffrey Fisher. I'm Jeff Finn, CEO at RealNex, and delighted to have you all back for our quarterly market update. As always, Jeff will give us his findings, having worked with the NCREIF data and his own perspective across the industry, what's happening in real estate markets by sector, type, pricing, key metrics and trends. And we'll invite all of you to participate in various polls to get your perspective of what you're seeing in the market, to share and give some additional color and commentary. And we'll open up the session for questions towards the end. As you have them along the way, please feel free to post them, and if they're appropriate, we'll interject and interact with Jeff along the hour. So without taking too much of your time, again, thank you, Jeff, for joining us. Thank you all for being here, and I will turn the screen over and we can get right into your presentation.
Okay, thank you, Jeff. Show my screen.
You're good to go.
Just do a little switching around here. Okay. So as you see on my subtitle there, we had the highest industrial returns ever in the history of the NCREIF index. It goes back to 1978. Thanks to industrial, we have had a nice recovery, and the index, at least when you combine all property types together, as we'll see, looks pretty good. Our usual disclaimer: don't believe anything I say. It involves forecasting anyway. But if we look at, of course, the last year, the S&P 500, really did well, but that was because you were buying right in the middle of COVID. So it was pretty hard to lose money on stocks, and that kind of pulled up NAREIT. But if you look at it over a long-term basis, as I think I've said several times, and you compare REITs with the private equity as represented by NCREIF, especially the NCREIF property index on the second one from the left there that says NPI levered. Those are the properties that have leverage, which I would argue is the most comparable with the publicly traded REITs. The return is virtually the same between the two over a long period of time. I point that out because a lot of times people look at REITs as kind of a leading indicator of what might happen in the private market. I don't know if it's leads so much anymore, but I think it tends to move more with the stock market on a day-to-day basis and the underlying real estate on a longer-term basis. I do have some data here on REITs. Actually came from somebody I did a webinar with a couple of weeks ago from Amherst, and I'm going to show some other slides from them. They're an operator of single family, among other things, and are working with several NCREIF members as the operator for the NCREIF member to help them have an allocation to single family. And what they were showing on this slide is, if you look at it, let me, there we go. If you look at it, the change from the year end 2019 through July 30th of 2021, so pretty recent data. The single family residential, and this is not REITs, this is investing directly in single family rental properties, 37.4%. Of course, I think everybody on this call knows what's been happening with home prices in most areas of the country. And that's attracted the attention of more and more institutional investors. So this was actually part of the NCREIF webinar, where they were kind of educating NCREIF members on why they might consider single family residential as an investment. You can see the REITs here, and we'll look at the returns for the private equity here in a minute, but apartment REITs 9.8% over that time period. Hotel, I don't think probably surprises in too many of these, as we'll see, similar to what we see in the private market. Hotel REITs minus 16, industrial REITs, which is your warehouse, 47%, very similar to what we see in the private market. Office REITs minus 11.7, so not as bad as some of the others, but and then the retail, actually it's kind of surprising the retail aren't worse, minus 0.8%. So the NCREIF property index is at a 10-year high. It was industrial that's at an all-time high, but the property index itself is a 10-year high, which is saying a lot considering what we thought might happen as we went into COVID. Who knows what Delta is going to do, but looks like we've had a nice, more than a V-shaped recovery coming out of COVID, and we're really at very respectable return levels. As a reminder, as labeled on the left here, this is quarterly total return. So you'd have to multiply by 4, and these are unlevered returns before even borrowing any money and getting the advantage of the low interest rates that we have right now. So pretty nice returns at 3.5% on a quarterly basis. So like 13-14% range on a annual basis. Cap rate declines have helped a lot on that, as shown here. The red bars are the impact of cap rate changes on the total return, and that's really offsetting the negative NOI growth that we've had in recent years. The green line's gone down to the bottom. Cash yield is still pretty good for private equity, but one of the reasons that yield holds up is the properties are marked to market every quarter. So if income is dropping, the value would tend to drop, although it's, again, because of the cap rate changes, values have been going up over the last year or so. So at least since COVID, they've been going up. I shouldn't say last year or so, but with the recovery of COVID, we've had this nice increase in values. This is the flow of funds into and out of the an index that we have that measures the performance of different open-end funds, kind of the main really well diversified open-end funds. There's about 12 funds in here, and I just put this in to give you an idea of whether more money is coming out of the funds right now than going in, and it is slightly negative. But from everything I'm hearing, there's still a lot of capital and actually queues to get into a lot of the funds right now. So I'd be surprised if that didn't turn positive over the next couple quarters, where there's more contributions into the funds than distributions out of the funds. By property type, you can see comparison of the most recent quarter, second quarter with the prior quarter, and industrial just really took off. I mean, it already had a really great return at over 4, but now like 8.5% quarterly. I have a hard time getting over that. Almost a 9% quarterly return unlevered. So 35% whatever on an annualized basis. Just no wonder that industrial is just really attracting a lot of capital right now. You wonder how long that can last. It's been going on for quite a while now, but we know these things don't last forever, where it's one sector that is attracting all the capital and having the highest return. But certainly it's still showing great returns. But you can also see everything has recovered at least a little. Hotel turned positive, apartments doing well. And we know there's been a lot of rent increases on apartments lately because of the high home prices. That's leading to a lot of people renting. So apartment returns are in a nice range, and even office and retail have recovered. So overall, I'd say it's pretty optimistic this quarter, at least ending in June. This just looks at it again by property type, but over more of a history. You can see that big divergence that we have between the industrial and the retail properties. We've never really had that much of a difference in the performance of two different property types. But I think we all know what's happening due to online shopping and that shift, and COVID kind of accelerated that trend. So not too surprising we have that wide a gap between the two, but I wouldn't expect that to last forever. Senior housing has also recovered. That's not in the NCREIF property index, but NCREIF collects data on senior housing along with other property types. And there's enough data on senior housing to break that out and see what the trends are. So along with the other property types, senior housing has recovered into positive territory this quarter. So always interesting to see what you all think. What property sector do you think will perform the best the second half of 2021? If we asked for the whole year, the answer would probably be industrial. Pretty hard for anything else to catch up. But if we're just looking at the second half of 2021, I could see a case for some of the other property types, even retail, if you catching it at the bottom. We'll see what everybody thinks.
Just give it a few more seconds, Jeff, and I'll have the results. But it looks like you may not be too surprised by the results here.
I think I can actually see it if I open this up.
Yeah,
we got 60% industrial, 20% apartments. So we got some people that, some people think it's going to be apartments, and the way rents have been going up, could very well be 10% retail and 10% hotel.
Couple contrarians out there, maybe looking for a change, strong recovery as people get back to it.
Nobody for office. Nobody for office. That's interesting, given that institutional investors typically love office properties, but they've never been the best performing sector. Well, maybe for short periods of time, but not when you look at it on a longer term basis. Okay. Looking at NOI growth by property type, it's going to be a similar story. Retail, they've all well, they haven't all gone up, have they? The blue in their apartment. Actually didn't go up, but that's I'd be surprised if increases in rent certainly in recent weeks. So I would expect apartment NOI growth. And NOI, of course, is after expenses, but I don't know why that wouldn't be going up. But the other property types all up. Retail had the biggest increase, although still in negative territory. So when we say it's improved, it's less negative in some of these cases. Industrial, of course, the highest. That's no surprise there. Office, even though nobody voted for it being the best performing over the remainder of the year, it's got the second highest NOI growth right now. And then looking at the vacancy, which tends to be highly correlated with rental growth and NOI growth. Although, look at office here now. Office is the highest vacancy, so lowest occupancy if we look at it in terms of occupancy. So even though it had some NOI growth, it's got still some pretty high vacancy. And then retail, the second highest vacancy, industrial, the lowest. Can't get much lower on vacancy on industrial, because not all warehouse properties are good, just most of them. And then CBD versus the suburbs. So you can see that the growth has really been in the suburbs at the highest returns for the suburbs. I think that's a flight to less dense areas, and we'll kind of see that on some of the other subtypes as well. So usually these shifts, at least since COVID, have been related to trying to be in less dense areas. So with apartments, you see high rise not performing as well as the low rise or the garden apartment. Again, the high rise being more dense. So kind of a theme that runs through here is moving to less dense. And then with the retail properties, think we all know that a lot of the malls have been in trouble, so they're the worst performing with pretty negative returns. The community centers, the more necessity-based retail has been doing better, although it's still in negative territory. Looks like neighborhood did turn positive. So neighborhood centers where you typically would have your drugstore, right? And again, the necessity-based retail. So that's kind of good to see that the neighborhood have recovered. Cap rates, again, have been what's really helped us. Cap rates just keep going down. Every time I've done a webinar in recent years, I say, I don't see how cap rates could go down anymore, but they just keep going down. And low interest rates are staying low, and inflation looks like it was going to come back, but it's kind of backed off recently. Lumber prices have kind of come back down. I like to look at the comparison between the cap rates and the BAA bonds. It's interesting that those really are highly correlated. Some exceptions during the financial crisis, but aside from that, looks like the direction of BAA bonds is going to be pretty indicative of the direction the cap rates are going to go. And then cap rates by property type. Apartments, almost always the lowest. There's just a slight exception there. But for the most part, apartments lower, I think, because viewed as a little bit less risky than the other property types. And also, you don't have the CapEx in apartments. Remember, cap rates are based on net operating income above the line, as we call it, whereas cash flows would be after taking out CapEx. So if you're looking at a cap rate before CapEx, I think since apartments tend to have less CapEx than the other property types, that would be one explanation that I've heard for lower cap rates for apartments. Not a wide difference in the cap rates across the different property types. Certainly at all-time lows, this only goes back to 1981, but you can see we've never really had cap rates this low in the entire history of the NCREIF data, certainly. So where will cap rates be by the end of 2021? They're currently around 4. There's been talks of inflation. You have to wonder if they're going to revert back to the mean. On the other hand, interest rates are low in most countries, and they certainly keep falling. So will they be below 4, 4 to 5, 4.5 to 5, or even above 5, which would be a huge drop in values, everything else being equal. So let me open this up. Polls, there we go. Okay, so nobody above 5 so far. That's good. Most people think we're going to be in the 4 to 4.5% range. Probably what I would vote. But there's 21% that think it could even be below 4. So, and 16% that have 4.5 to 5. So, actually, it's pretty symmetrical with 21% below 4, but 16% the 4.5 to 5. So, looks like we all think, as a consensus among the group, the cap rates are going to go up a little. Not a whole lot, but go up a little. All right. Transactions, you can see the impact of COVID, although it wasn't as bad as it could have been. Although this is a 4-quarter moving average, if you looked at it quarterly, it'd be kind of noisy. But we got down to where there was only 30 transactions during the worst of COVID. And I like to look at transactions because transactions are really indicative of a healthy market. You might think, well, this means NCREIF members are selling their properties, but they're turning around and buying other properties. They're repositioning their portfolio. They're taking profits, and usually transactions going up, or I should say they go up at the same time returns are increasing and vice versa. So like you can see back in 2008, 2009, a very low number of transactions when returns were low. So I like to see transactions going back up. 150 is probably an average over time. So that's kind of a nice level of transactions to be at. So no big concern about transactions right now. This is actually a slide that Amherst that I mentioned put together. And I think what's surprising here is it's not the cities you would expect to be the ones that are performing the best. You don't have the, for the most part, the gateway cities that you would normally expect to see the best performing. Indianapolis is the second best. I mean, you wouldn't expect Indianapolis, Newark. It's just not the cities you'd expect to be the best. Riverside is no surprise because that's impacted by industrial, but kind of surprising what cities ended up, at least during 2021, being the best performing. Any surprises here for you, Jeff?
Yeah, I think it's a lot of surprises. Forever it's been the major markets across the country. Capital was tough to get into places like Newark and Camden, and to see those performing so well is really interesting, and it's healthy. I mean, those markets need it, and to see the capital coming out of New York into Newark or out of Philadelphia into Camden is it's going to be very good long term to help those markets improve.
Actually, let me jump to this one because that ties in with the last one. I put this together because there's always talk about the gateway cities is the ones that are supposed to be where the institutional investors like to go, and that's your Los Angeles and San Francisco, Chicago, Boston, New York, and DC. Different people might have slightly different variations of what they consider the gateway cities, but if you compare the gateway with the non-gateway, look what's happened since really since COVID and over the last like 4 quarters. The non-gateway just really took off. I maybe that ties back in with going to less dense areas.
I think it's a combination of that, Jeff, and also where the return is, as was pointed out, because when you got to a point where there was such compressed cap rate in these gateways where all the money was chasing, it seemed always natural for it to flow out as long as there was liquidity there. And with increased liquidity, those markets opened up for the new opportunity, as well as to get for the investor going in to get the higher return.
Right. So I skipped over this one, but these are the combinations of CBSA and property type that moved the NCREIF property index the most, either in a positive or a negative direction. So you can see again, Riverside, which we saw on that previous chart, is the one that moved the index the most. New York, and then the reason there's some differences here, first of all, I'm looking at it by property type, combined with the CBSA, so picking out that property type that moved the index. But also this takes into consideration how much capital is there. So a lot of capital in New York, so it doesn't take much of a higher return to move the entire index in New York and DC and LA. This tends to be more important for the NCREIF members that need to beat the NCREIF property index. A lot of times they're in an incentive fee and look good as a manager. So if they did not have an allocation of capital to Riverside, it really hurt them because that was what moved the index the most. So where will institutional real estate values be by the end of 2021? I don't know that it would be any different for all of real estate if we're just saying, are they going to be higher or lower? So values will be somewhat lower by the end of 2021. Returns and values will stabilize, or they'll be somewhat higher, or you have no idea. Somewhat higher so
Not quite
far.
not quite the bell curve this time. Interesting.
Yeah, that's so we do have 24% that say somewhat lower.
Let's show the
Um,
poll. Yeah.
yeah, 5% admitted they have no idea. I'm not sure I really have an idea. I'd probably vote for up slightly, but wow, there's just a lot going on right now. You got such a disparity across property types, and you got the uncertainty of Delta, and are people going to come back to the office and work or stay at home? And
But you still have that BAA bond trending down,
yeah,
supporting
so
the
that
market.
cap rates will help, but in order to keep the returns going, they have to keep falling though. They can't just stay the same. Interesting. Okay. Yeah, I got to go back over here. I put this in. It's a little different kind of chart than maybe you're used to seeing. I like to show this a lot in different NCREIF courses. This is looking at the return over the whole history of the NCREIF index, along with the standard deviation of the returns, the volatility of the returns, which is often used as a risk measure. I like to have students look at something like this, and we know you're supposed to get a higher return if you take on more risk, or say that better, your expected return should be higher if you take on more risk, but that's not always what happens, right? I mean, that's the risk, that you may not get that higher return. And over this entire time period, 1978 to 2021, you can see office has the lowest return, and except for hotel, which is really kind of a different animal, has the highest risk. Yet it's probably 35% down from about 40% of what institutional investors invest in. So always kind of a puzzle. Why so much capital into office when it just really doesn't do that well? Not that there aren't time periods that it doesn't do better, but um, certainly over the 78 to 2021 period, if you'd have been in an industrial, and actually not much different for apartments. Apartments, just a tiny lower return and slightly higher risk. Probably not enough to really be statistically significantly different. Retail, of course, really got hurt by what's gone on in recent years, so that pulled down the return. It is kind of interesting that actually the standard deviation isn't too different for retail, industrial, and apartment. It's really office that's quite a bit higher in terms of the volatility, which is kind of surprising in a way, I guess. You'd think the lease structure of retail would tend to result in less volatility, but it's really the cap rate changes and causing that higher volatility, I think. Hotel, not a surprise, right? Because those, occupancy, if you want to call it that, in hotels can change daily. Okay. A couple slides here from Amherst. Again, they were showing what's going on with single family, and you can see the home prices just shot way up by May of 2021. 15% year over year change in home prices. They put together a price index, which is on the right, so you can see how the level of prices has just really shot up. So as I said earlier, that's why it's attracting institutional capital right now. Sales volatility really jumped up. Not volatility, velocity, big difference. Sales velocity jumped way up. There's a lot of capital coming into it, and you can see the kind of what the universe is for single family properties here. So all housing units estimated at about 35 trillion. That breaks down into renter occupied and owner occupied. The renter occupied is about 10 trillion, and then that would break down into single family versus multifamily. So the single family portion of that is about $4 trillion, and then institutional investors currently only have about 83 billion. So I think the point that they were making here is just a lot of room for institutional investors to move into the single family rental. It's a huge asset class, if you want to call it an asset class. We usually think of real estate itself as the asset class, but within the real estate asset class, single family residential could be considered a pretty significant component, with only 2% institutionally owned at this point. And probably the ability for institutional investors to come into single family is relatively recent, with the kind of operators that really handle the day-to-day operations and have the computer systems and the ability to standardize the appliances and really run those properties efficiently now versus what maybe could have been done 10 or so years ago. So I would, based on the questions that we're getting at NCREIF about whether we can start tracking single family performance, I would guess there's going to be continued institutional interest in single family rental properties. If you're like me, you get something almost every day, a phone call or a letter. Somebody wants to buy your house, right, Jeff? So kind of a
In
summary
this
of,
market, that's for sure.
yeah. So kind of a summary of the NCREIF data. Returns at a 10-year high, but industrial at an all-time high. Transactions are really back to normal levels. Cap rates continue to go down, which is what's helped the return. Inflation may or may not impact cap rates going forward. We'll see what happens to inflation. Although real estate has typically been a good inflation hedge. There's people arguing, we're not worried about inflation. There's others that are arguing that, well, maybe this time will be different. So we'll have to see. But certainly the lease structure, expense pass-throughs, the fact that it's a real asset, and construction costs go up with inflation, all that tends to make it pretty good place to be typically in an inflationary environment. I don't know that we still know who's going to be the winners and losers as a result of COVID by different property types and geographic areas. I think that's still unfolding, and debates going on about what's going to happen with office space. So we'll just have to stay tuned on that one. So a little quicker than usual, but I think I gave you a pretty high level update as to what's going on, at least in the institutional market, which tends to follow the whole market.
That's great, Jeff, and it's really it's played out in some ways as to be expected. Some were a little bit surprising. I think the speed and the strength of the market and how far it's come and how quickly. But there are some changes afoot, or potential changes afoot, that might impact, and those go beyond the supply and demand sort of current economic factors, and it's things like the 1031 potential change. It's the Fed changing its policy
Right,
on
and
the acquisition of bonds.
Tax rate
And
changes. Yeah,
exactly. So what's your view on how this governmental activity might play out, and what would happen in different scenarios?
boy, that's a tough one. Haven't thought a lot about that. I know there's a lot of concern right now of capital gains tax rates going up, and should we sell now? So there may be some additional transaction activity as a result of that. I don't know that the tax law changes will impact real estate more than other asset classes, right? It's always relative changes that are important. So if you have to ask yourself, are any of the changes in whether it's tax laws or whatever, do they have a differential impact on real estate versus other asset classes? And that's going to kind of tell you who the winners are going to be and who the losers are going to be. Don't know if I have any great insights beyond that. I'm kind of worried about what's going on internationally right now in cabal, but yeah.
And as well as the relative global interest rate. That's one of the issues that continue to, I think, support the rates here, is how low they are in generally weaker economies around the world.
Right. And last I looked, interest rates were lower than the US, just about every other country.
Exactly. So we are open for questions. please feel free to chime in, and we'll see what we can address.
Or comments.
You'd love to have your perspectives as well.
Yeah.
It's interesting, Jeff. This new residential class. When you look at the breadth of that in the market, you had sort of a small percentage of the overall sector had been invested in by institutions, but of institutions, how many are dabbling? Is that like 2% spread over many, or is it just a couple that have taken the lead and others are expected to follow, or have they all put a foot in the water and beginning to grow market share?
From what I've heard, it's only a couple right now, but lots of calls about it, and interest in it, and we're trying to figure out bracket would. Usually we collect data on every individual property. I don't know that we can handle collecting data on every individual home. On the other hand, the operators like the Amherst, they do track what's going on with every single property. When they buy a property, they go in and they standardize all the appliances, so that that makes it easier to do repairs efficiently, and they've got everything in their database. And they're using AVMs, automated valuation models, to track what's happening to the performance of the properties, which is how they can put together those price indices. And from what I could see, they're pretty sophisticated in how they handle that, and they're really geared up to allow institutional investors to start doing an allocation to single family residential. So I'd be surprised if that didn't increase now that the kind of the operators are in place that can handle it for the institutional investors. They would do a joint venture. So your typical institutional investor is not going to go out and buy single family homes. They're just not geared up to do that. So they're going to do a joint venture with an operator, where the operator handles all the acquisitions and day-to-day operations, and usually gets some sort of performance fee, like a promote, if they deliver a certain rate of return.
It's interesting. It ties in with one of the questions that just came in, but those sponsors and subsequently the funds that came in behind them were born out of the Great Recession, the financial crisis 12, 15 years ago. And with this cycle, a lot of what would have been opportunities to foreclose on and buy residential didn't occur because of the forbearance. Or is there sort of a pent-up demand of capital waiting for that type of flow through once this relief, governmental protection, or whatever you want to call it, is gone, and properties begin to go through the normal cycle?
Yeah, well, that's
was there discussion on that at all?
No, I haven't heard any discussion of that, but kind of makes sense. Probably areas where there's rent control are not going to be as attractive to institutional investors.
But I think it could help stabilize the market, because if there is a wave of foreclosure, this type of capital formation that didn't exist before is there. So It just doesn't go out to retail individual homeowners, potential new buyers, or bottom fisher type of buyers, but it's going to get more of a wholesale type of buyer that could come in and support the banks through the process.
We've seen this rise in home prices, which is attracting institutional capital, but as institutional capital comes into that asset class and makes it more efficient, and investors willing to accept lower rates of return because they can hold a well-diversified portfolio, and single family may even lower some of the risk of the portfolio because it behaves differently than the other property types. I could see where that would continue to push up home prices. In other words, it was the high home prices that attracted the institutional capital, but the institutional capital being in single family could push up home prices even more. So that may be the place to be right now. No wonder we're getting all these letters. People want to buy our homes.
It's quite interesting. Jeff, do you have any experience or expertise in the opportunity zone area? There's a couple of comments about any.
No, we have a hard time getting those people to contribute data. They all want to keep their data secret, and those tend to be your higher risk, hopefully higher return funds. I have seen some academic studies. This is interesting though. So I guess the question is the difference in performance of the more opportunity types of funds compared to the core funds. And there was a couple studies done that has shown that if you invest in core funds, but you leverage it up, you can actually do better than investing in the opportunity funds. So that's, of course, function of that time period that the study was done over, but it does raise the question of, what's the best way to get a higher return where you're willing to take on more risk? Is it just leveraging up an investment that otherwise wouldn't have a lot of risk, or is it investing in riskier properties?
Just an observation from one of the participants about the various real estate associations and groups, are doing what they can to protect the 1031, and thoughts that if this is removed from the market, the both activity and pricing will have substantial impact. It seems that it comes up regularly, and it has never happened. So hopefully the lobbies will continue to protect that.
Yeah, when the Trump administration was looking at tax law changes, that was a big concern. And there was actually a study done, David Ling at the University of Florida, for the Real Estate Council. And they kind of concluded that the ability to have exchanges was good, resulted in people holding properties longer, putting more capex into properties. And so there have been some studies that have argued from an academic perspective we should keep the 1031 exchange, but who knows? It is a way to try to get additional tax revenue, right? I'm glad they had it when I was selling a condo at one point. Worked for me.
Yeah, it's something it's forever debated, but it seems like it also creates the type of liquidity and transactional activity that supports the economy, and it may be perceived ability to capture a taxing opportunity would just go away. So really, this might be a false hope. In any event, it looks like there's some comments, and let's see. No, there's a lot of comments here, support, in the debate, but no additional questions. So, Jeff, I think you covered the basis for us today. Hopefully, we come back again in a quarter and continue to see stable, strong markets, healthy recovery, and less and less COVID, and that would be a good thing for all of us. So, if everyone does their part to help support the improvement in the health of the world, will improve the health of the economy. So, Jeff, thanks for your commentary. Thank you all for your questions and joining us today, and hope you all do well and stay safe, and we will see you next time.
Thanks, Jeff.